Good evening, everyone, once again, and hearty welcome to today's webinar. Let me begin by thanking you all for taking the interest and time to join us today on a discussion over the introduction of corporate tax in the UAE. My name is Jyotika Ranjit, and I've been working with Kothari Auditors and Accountants in the Tax and Compliance Department. Before we proceed to the session, I'd like to give a brief introduction of our company, Kothari Auditors and Accountants, known as KAA. Established in the year 1992, KAA has been proudly serving in the professional field for more than 29 years, providing management and financial consulting services, including audit, accounting, VAT, and company registration services. KAA is operating in two offices located in Khalid bin Walid Street in the Emirate of Dubai and Bank Street, Rola in the Emirate of Sharjah. Our associate office, Global Business Services DMCC, also known as GBS, which was established in the year 2010 and located in Jumeirah Lake Plaza, Dubai, specializes on formation of global entities, trusts, and foundations in the UAE and worldwide. As you're all aware, the tax landscape in UAE is constantly evolving, and with the introduction of corporate tax with effect from June 2023, it's time to gear up our businesses to ensure effective adherence to the regulations. As always, the KAA GBS Group is committed to ensure that our clients are aware of all the aspects of the newly introduced law and to step into their shoes by anticipating the queries that would arise in their minds. With this note, I'd like to introduce our speakers for the day. It's my privilege to introduce before you Mr. Vipul Kothari, the founder and head of KAA and GBS. He has the distinction of passing the Chartered Accountancy at the age of 21 from the Institute of Chartered Accountants of India and went on to receive gold medals from Beatty School of Business Management in MBA Finance. We also have with us Ms. Kinjal Mehta, the Manager Tax and Compliance at KAA. A Chartered Accountant and Company Secretary by profession, Ms. Kinjal holds a rich experience of 10 years in the field of direct and indirect taxation in India, Kuwait, and Dubai. She also holds a Diploma in International Taxation from ICI. The question and answer session will be taken over by Mr. Prasad Bhunde, Senior Manager, Audit and Taxation, who is also a Company Secretary in addition to many more professional qualifications and has over 20 years of experience in the professional field. Before I hand the session over to the speakers, please note that the call is being recorded and all the participants will be muted. In case you have any questions, please raise them in the chat box and we shall answer them at the end of the session. So without waiting any further, let's move on to the session. Over to you, sir.
Thank you, Jyotika. Thank you for your kind words of introduction. Good afternoon. Welcome, everyone. Hope I'm audible. If my sound is not okay, please let me know. So good afternoon. Welcome, everyone, to first in the series of many such knowledge series webinars that we would be holding to share with you the information and knowledge about the corporate tax. As you are well aware, recently UAE has announced corporate tax to be implemented, and today's webinar is an effort to give a broad outline based on the currently available information. So this is not a legal or a tax advice per se, because that would need to be evaluated and assessed based on every company's requirements, their business, and the books of accounts and other matters. So just a minute. Yeah. So the first part is, in terms of the introduction and a broad overview that I would like to share. Ministry of Finance of UAE had recently announced that the corporate tax would be introduced on business profits, which would be effective for the financial years which are starting from 1st June 2023. So the tax would be applicable on the net profits which are earned on the UAE businesses, which are reported in their financial statements and which are prepared in accordance with the international accounting standards. And of course, there would be certain adjustments which the corporate tax regulations would be mentioned, and those will be primarily certain allowable or disallowables, which are generally the cases across the globe. As we are all aware that UAE believes in incorporating the best practices which are prevalent globally, and that's why I'm very certain that there would be minimum of compliance burden. Though the UAE tax authority, Federal Tax Authority, has still not released the final version of the tax law, corporate tax law, and the regulations, they've come out with broad guidelines. And today's webinar is based on those broad outlines which have been announced by the Federal Tax Authority and the Ministry of Finance. The region as such has many countries which have taxes already prevalent. And as you can see from this particular slide, UAE, which has announced 9% corporate tax above the slab of 375,000 of net profit, is one of the lowest. Of course, Bahrain does not currently tax on majority of businesses, though it does have taxes on certain activities, but on majority of businesses, it does not have corporate tax. But having said that, in today's environment, not having a tax and corporate tax is going to be a negative factor from the country and the jurisdiction perspective, and that I'll come to in the next slide. So UAE is coming up amongst the peers, if you can see, at a very favorable rates, and even compared to internationally known jurisdictions like Singapore, Hong Kong, it is quite lower as compared to those jurisdictions as well. So this is one of the positive factors which is in favor of the UAE. Now, where did it all begin? As you all are aware, this has been in progress since many, many years. And it's not just in 2017, but even prior to 2017, there have been various groups, primarily the OECD, which has been focusing on tax havens globally. And they've come out with various regulations time and again, starting with sharing of tax information, so-called tax exchange information agreements, and signing of the double tax avoidance agreements, and so on and so forth. In progression, what had happened is many of the countries and the OECD particularly and the European Unions had started blacklisting certain jurisdictions which they deemed as non-cooperative. And because of this reason, majority of countries globally have now adopted to various measures from tax transparency and tax chargeability perspective. So UAE, which was in the gray list or blacklist by the European Union, and thereafter, of course, there have been various discussions and negotiations which had happened between the authorities as well as those organizations. As a part of that, UAE implemented, of course, VAT, which was implemented in the year 2018. There was country by country reporting, which was made mandatory for large multinational corporations, which had turnover in excess of 750 million euros or 3 billion plus dirhams. The next step was in 2019 introduction of economic substance regulations, which mentioned that any company which is operating within UAE and carrying out certain relevant activities will need to ensure that they show substance in terms of adequate infrastructure, adequate operational expenditure, adequate number of employees, premises, and all that. So this was again to ensure that UAE is not used as a pass-through destination for routing of the international transaction and just from the purpose of avoiding taxes in other jurisdictions. And corporate tax, as I believe, is the last piece in the jigsaw puzzle, which basically will complete the entire cycle and which the OECD and the BEPS action plan, which we'll see in the next slide, is meant to cover. So the corporate tax has been announced and the regulations are expected to be announced very soon, the detailed regulations, and then the implementation would start from the 2023 June onwards. So the advantage that UAE would have in this is primarily with the introduction of these regulations as well as anti-money laundering laws, the tightening of the anti-money laundering regulations. The UAE per se is going to cement its position and will be a leading global business hub. And this is going to actually accelerate UAE's transformation, because large corporates, multinationals, and global funds, which generally invest billions globally, generally look at these aspects, apart from, of course, the business environment. And this will really reaffirm UAE's commitment to meet the international standards for tax transparency and prevent the harmful tax practices. And that is the reason it would become a favored destination. And that's why if you see in last many years, UAE and Dubai also has been one of the largest recipients of the foreign direct investment. Now, what is BEPS action plan? See, what happens is primarily many multinationals have been found to set up entities and subsidiaries globally in jurisdictions which have very, very low tax rates. So the actual operations could happen somewhere, the businesses could be somewhere, whereas that gets recorded and booked in a jurisdiction which has low taxes. And this results into erosion of profit and shifting of profit, which results into loss of revenue for very many governments. And because of this, the OECD was very much behind this with various jurisdictions to ensure that the BEPS action plan is agreed to by the countries which are signatory to the OECD and which have agreed to these implementation of these rules and regulations. So as a part of the global anti-base erosion rules, Pillar 2, which has been agreed to by UAE as well as many countries, and just to name a few, this includes countries which primarily earlier did not have taxes or had very low rates of taxes. Because globally now, a country which does not accept to these rules regulations is likely to be blacklisted, and it will have a major impact on FDIs as well as in ensuring that they are connected to global business environment. So these rules would mean that the multinational corporations, of course, pay their fair share of the taxation globally on their global profits, and not just that they park profits in some or the other jurisdiction and are able to evade or minimize their taxes. As a part of this, it also means that the local entities which are in those countries also will have to pay some form of taxes. And because of this, the rules and the corporate tax implementation, which is now being proposed, is coming into force. So I will, on the key announcements part, from the perspective of what these rules are saying, what is known till now, I would request Kinjal to take it forward. Thank you, Kinjal.
Thank you, Mr. Vipul, for such an insightful overview of why CIT is getting introduced in the UAE and how UAE still continues to be an excellent place for doing business. Good afternoon, everyone. I hope you all are doing good and keeping safe. Let me just share my screen. Can see my screen now?
Yes.
Okay. So good afternoon, everyone. My name is Kinjal Mehta. I work as a manager, tax and compliance with Global Business Services, DMCC. It is my privilege to present to you the key announcements which potentially would become one of the most important piece of legislation in this region. Now let's look at what has been announced. On 31st January 2022, MOF announced the introduction of CIT in the UAE. This was not an unexpected announcement with the development of OECD and the BEPS 2.0 program. 47 FAQs presented on the MOF website laid down the principle, scope, rate, tax, and the compliance regime for this corporate tax. So let's see when it is effective from. The timing is really interesting. In principle, the announcement was made that CIT will be introduced for businesses and license holders with the financial year beginning on or after 1st of June 2023. What it practically means is that most businesses with calendar year and they will not be subject to CIT until 2024, meaning a tax return will not be due until 2025. This means the businesses have 16 to 22 months of time to prepare for the CIT regime. I know it's a marathon, but businesses should start preparing to ensure they're ready for implementation in the due course. So the main question here is, who is going to be subject to tax? CIT will be a federal level tax. According to the FAQs, CIT will apply to business activities carried out under a commercial license in the UAE. This includes legal entities such as companies, branches, etc. And it also includes individuals if they conduct business activities under a commercial license. Further, there is an exception given to the oil and gas upstream activity companies. They will be outside the purview of CIT and they will still remain subject to the emirate level corporate taxation. How about the individual taxation? Tax on the personal income earned by the individual. So if an individual who's earning income from activities which are not conducted under a commercial license, for example, dividend income, interest income, income from real estate activities, which do not require a commercial license, they will not be subject to the corporate income tax. So if any income which is earned by the individual in their personal capacity will not be subject to tax. Also, the interest income earned on bank deposits will not be taxed for individuals. There are certain exemptions also given in the FAQs to dividend and capital gain income earned by qualifying shareholders. Qualifying shareholding refers to an ownership interest in a UAE or a foreign company that meets certain criteria. FAQs don't provide us the conditions. However, as a benchmark under the Pillar 2 approach, a qualifying shareholding is a shareholding that is greater than 10%. Also, there is another exemption that is given to qualifying qualifying intra-group transactions and reorganizations, which will not be subject to the corporate tax. What will qualify under these exemptions? Of course, will be subject to certain conditions, which are yet to be announced. Foreign entities and individuals will be subjected to UAE corporate tax only if they conduct trade and business activities in the UAE on an ongoing and regular manner. Currently, they have not defined what is trade, what is business. However, any activity which is done on a regular and ongoing basis will be classified under doing business. Further, UAE corporate tax will not be levied on foreign investors' income from dividend, capital gains, interest, royalties, and other investment returns. Of course, this will be subject to certain conditions that we will have to wait for them to release. One more relief that they have given is about the withholding taxes. UAE will not withhold any taxes when the payments are made on domestic or cross-border payments of any nature. So that is a big relief. So how does it start? What would be the first step, the starting point, the tax base? According to the FAQs, the taxable income is the accounting net profits of a business after making the adjustments. The accounting net profit is the amount reported in the financial statements prepared in accordance with the internationally accepted accounting standards. Now, at this point of time, we have no information on what adjustments will be allowed to be deducted against the taxable income. However, we do expect that these adjustments would be in accordance as set out by other countries, which would ideally be the business expenses. Further, in terms of rate, currently the FAQs have proposed a progressive tax rate, where for all the businesses, taxable profits will be taxed at 0% for up to 375,000 dirhams, and any profit above 375,000 dirhams will be taxed at 9%. There will be also a different tax rate for large multinationals that meet specific criteria as set by the Pillar 2 of the OECD. As we all know, the global minimum tax rate is set at 15%. However, we need to see how this will be implemented. Further, the foreign tax paid by a UAE taxable income, the foreign tax that a UAE company would pay on the UAE taxable income will be allowed as a tax credit against the UAE tax liability. So currently what is happening is, whenever a UAE company pays a withholding tax in a foreign company, it becomes a cost for the UAE business. However, with the introduction of the CIT in UAE, the UAE businesses will be allowed to claim the withholding tax that is paid in another country as a deduction from the corporate tax payable in the UAE. So how is the tax going to be calculated? We need to first assess what is the net profit from before tax as per the financial statements. We need to do the adjustments. We need to add up the expenses which are not allowed for the tax purposes. We need to reduce the income which is not taxable. We need to add or less other adjustments. So the adjustments which could be adjusted or deducted are yet to be specified, but generally we feel all the business related expenses would be allowed to be deducted. Sorry. So once we come to the taxable income, the first 375,000 will be taxed at 0%, and the balance income would be taxed at 9%. Sorry. Going to the free zones, probably this is the most hottest topic, that how the treatment would be done for the free zones entity and the free zone operations. The FAQs state that the free zone shall be subjected to the corporate income tax. However, they have also mentioned that they will continue to honor the commitment that they have given to businesses registered in the free zone. This is subject to fulfillment of certain conditions. The first condition is that the free zone companies will have to comply with all the regulatory requirements. The second condition is that they should not be conducting any business with the mainland company. Now, there can be two situations. The first situation could be when an entity in free zone is dealing with the rest of the world. They are only earning foreign sourced income. In that case, the income will be subject to tax at 0%. However, if there is an entity who deals with the foreign sourced income as well as UAE mainland and earns income out of both the sources, we need to see how the CIT regime would work for them. So ideally, it is right now not clear whether the incentive would apply only to the foreign sourced income or all the income of that company would be taxed. I think this would be a key area to focus on once the detailed law is issued. With the introduction of CIT comes the introduction of transfer pricing rules. Under the CIT regime, the UAE businesses will be required to comply with the transfer pricing rules and documentations as set out in the OECD framework. We expect that potentially there would be mandatory submission of TP documentation like the master files, the local files. However, they may not be that exhaustive and detailed compliance. We still await to hear about the TP methodologies and the TP concepts, which will be made available to us shortly by the competent authorities. Further, the UAE group of companies can elect to form a tax group and be treated as a single taxable person for the purposes of corporate tax. In this case, only a single tax return will be required to be filed by the entire group. One more option is given that the losses from one group company can be used to offset the taxable income of another group companies. We expect further information to be released in this regards. In terms of tax compliance, right now, not much information is provided, but the FAQs mention that all businesses will need to register for the corporate income tax and file a corporate tax return. This includes the free zone companies and the financial free zone companies. The returns have to be filed on an annual basis in electronic mode. There is no requirement to pay advance tax. Also, they have mentioned that non-compliance to the corporate tax rules will be subject to penalties. With this, I would like to complete my presentation and hand it over to Mr. Whipple to continue further.
Thank you, Kinjal. I'll just share the slide. Okay, thank you, Kinjal. So, as you have seen with the information what is available till today, the details what are available looks very simple, and I'm assuming that things, when the tax law really comes out, will not be as complicated as we see in some other countries, where we have a lot of deductions and a lot of adjustments which happens. But having said that, there are, I think, quite a few things which will need to be, I think, looked at while doing the planning and preparation for the corporate tax implementation. So what are the next steps for business? The implementation is effective for financial year starting in June 2023. So businesses have enough time to evaluate their business operations, to assess what would be the implications from tax perspective, and take a decision on how to move forward. Obviously, you'll have to examine the facts and the applicability of regulations as and when they are announced. There would be quite a few gaps and potential challenge areas. And specifically, I think this would be relating to the few of the things that I can highlight here is like transfer pricing regulation. As Kinjal mentioned, this would be one very important aspect. There would be companies which have transactions with their group companies or related parties. And these will have to be in accordance with the OECD transfer pricing guidelines and regulations. So that will have to be assessed, that are they in accordance with what the UAE corporate tax regulation requires? If they are not, there is a possibility that those transactions could be disallowed partially or fully, or there could be some deemed profits being added on top of your actual net accounting profits. Other major thing, which also will need to be looked at is in the related party transactions is the director's remuneration, the interest payments, the royalties, technical fees, which are being paid to the shareholders or directors. And these will definitely be subject to corporate tax regulations. And I'm sure there will be some broad outline and guidelines that will come out that within these parameters would be allowable. If it is beyond this, it may not be allowable. Now, if that is the case, what could happen is primarily the company's accounting profit could be lower. But when you add up these disallowable expenses, the net taxable profit in accordance with the corporate tax regulations could be on a higher side. So in that case, the effective tax rate could be higher than the 9% because you would end up paying tax even on the disallowable component of the expenses. On the other hand, if you have international transactions, if you are based in a free zone and do not have businesses within UAE, then as it is mentioned, the assurances and the free zones have given assurances that it will remain outside the purview of the corporate tax for a certain number of years. So if that period has not yet expired, in that case, those free zone entities will not be chargeable to corporate tax, though they will have to do the compliance with respect to filings, but they would be ideally getting the exemption from paying corporate tax till such period of time. But provided the businesses are not with UAE or UAE based entities and businesses are not, done outside the borders of the UAE. So if this is the case, the effective tax rate would be lower than 9% in that case. Now, how do you actually ensure that all the genuine business expenses which are being incurred and recorded in your books of accounts are allowed? In order to do that, you'll have to ensure that proper documentation is in place. Agreements with the vendors, with the service providers, and especially for the intangibles, like the services that you avail from different parties. For those also, proper agreements, documentation, and ensuring that these are on arm's length pricing basis in case if it is with related parties, along with the supporting documents with respect to payments that are being made to these parties. So these are very critical documentation that would need to be maintained, and all of these will have to be maintained again for a period of 5 years, as is the case in case of VAT. So effectively, we'll have to maintain more than 5 years, because it would be after the period of filing, they would have a right to assess it during that period. So all of this will have to be assessed, evaluated, and then considering this, many companies will need to ensure that their either accounting systems or processes or the chart of accounts will need to be modified to ensure that they are in compliance with the corporate tax regulations. Because here in UAE till now, and specifically prior to the introduction of VAT regulations, documentation, what we have seen, was lacking in many cases. And that's where the issue comes, that if documentation is lacking, there are possibilities that certain expenses, though it might be genuine, may not be allowed, or at the time of assessment, it could be disallowed, and which would increase your effective tax rate. One more impact which would be there on all the businesses is going to be the cash flow impact. What happens is that you have an accounting profit in the books, which eventually gets converted into your taxable profit. However, that may not be the amount that you would have already collected because of the outstanding receivables or money blocked in the stocks, or the asset values having gone up and resulted into the profits. So all of these, if it is there, the cash flow would not align with your profits. And that's where there would be a challenge, because the corporate tax filing happens and then the payment will have to be made. Now, whether you realize that amount or not would not be looked at. So cash flow also, and cash management and fund management would be very critical. And as we have seen, even in case of VAT regulations, that when the law is announced and the guidelines are announced, executive regulations are announced, there are certain gray areas and clarity is not there on many aspects. Gradually, over a period of time, the Federal Tax Authority, as in the case of VAT, has been sharing the guidelines or guidance notes or clarifications. Similarly, in case of corporate tax also, we expect that this will happen, where the gray areas are gradually getting resolved. And that's why the corporate tax division or the accounting division, which would handle the corporate tax matters, will have to be regularly updated of the new clarifications, guidance notes, and amendments which would happen from time to time. One advantage also would be there, that till this date, if an UAE company has paid tax in a foreign land on their UAE based income, that was to be expensed out, because there was no way to claim it back within the UAE. Now, with corporate tax being introduced here, there is a possibility that the foreign tax paid could be claimed as a credit against the tax liability in UAE. So this would be a positive impact. On top of it, the compliance cost is one which will have to be looked at, because obviously with all these additional documentation, records to be maintained, regular review and updates to be done, the in-house compliance and the compliance team would be required, or probably outsource it, and that cost is going to be factored in. From accounting point of view, again, there would be certain deferred taxes that may need to be recorded, or there would be certain differences, as you have seen in other countries, that you have different rates of depreciation for Corporate or Companies Act and different rates for probably, so if there are some incentives being given to the businesses in UAE, then in that case, different records will need to be maintained specifically to track that what have been the changes. So all in all, though it looks simple, there could be many hidden challenges that would come up from time to time when you start the implementation. And that's where we feel that though you have still 1.5 years, or in some cases 2 years, but you need to start moving quickly. At least start assessing, because the regulation or the law is still not out, the specifics are not known. But one thing is very known, that the accounting records documentation has to be perfect. And that is where one can really start right now, that assess what are the expenses that you are incurring. Do you have all the agreements in place for those contracts with the vendors, with the service providers, with your suppliers? Are all their purchases from them, or the services that you avail from them, are they supported with proper invoices, approvals, and the payments which are being made? Do you have proper records and documentation for that? And ensure that that is in place. Identify that what are your current transactions with related parties which could come under scanner, and try to see that are they on the transfer pricing guideline basis, on arm's length basis, or not. Because these are the things which will take time to modify or implement the changes in. So these are the things which one can start. And of course also assess internally, that is your tax team or your accounting team equipped to independently handle the corporate tax compliance filings and record maintenance that would be required. If not, you'll have to start looking at recruiting and ensuring that the team is in place, so that at last moment there are no issues. Because I'm sure the penalties again would be there and would be sizable in case of non-compliance in any of these matters. And that's where there would be responsibilities on the top management also, to ensure that these are taken care of at the earliest, and you have the infrastructure ready to handle this. Because as it happened in VAT also, that once it gets implemented, it is fully implemented and there are no extensions thereafter. And this is what we expect also, that there may not be any extensions in the implementation and the filing deadlines which are being which would be laid out once the regulation is announced. So how we can handle this, or how we can support in this, that prior to the regulations being announced, there is phase one, where what are the areas which may need to be looked at. So prepare, understand, and keep that part ready. As soon as the regulations are announced, do a detailed assessment, design and plan for how to implement and ensure that you are fully compliant. And then the implementation phase comes, which would start from the effective date of the law, or even I would say prior to that, because your systems processes will have to be set and ensured that they are able to handle those changes which are required to be done. And then obviously the operational support, which is on an ongoing basis, as and when the implementation has happened and the filings have to be done on a periodical basis. So this is where we could guide. And let me assure you again that as the regulations will get announced soon, we will come up with the updates and have more events to ensure that we are able to cover the nitty-gritties of the corporate tax rules and regulations in detail. And obviously from the individual business perspective, we are always available phone call away to discuss on any specific matter, and we'll soon of course reach out to many of you one-to-one to ensure that you are ready to implement this on the required timeline. So with that, I will stop the presentation, and thank you everyone for attending today. We will open up for question answers. So of course, anyone who has questions can write in the chat mode, or you can raise a hand. So our panelists, they'll unmute you and you can ask your question. Thank you, everyone. Over to Mr. Prasad for the question answer session. Thank you.
Thank you, sir. Thank you very much. I hope I am audible.
Yes, you are.
Yes, thank you. It was a very insightful session from both the speakers, Vibhul sir as well as Kinjal. A lot of doubts have been clarified. Obviously, we are waiting for the detailed regulations to come up. So more and more as and when we get the regulations, we will definitely, as Vipul sir said, we will definitely keep the clients updated. So as of now, let us begin the question answer session. Before we take the questions from the attendees, I had a question of my own. According to the initial information, the income tax return will be filed on an annual basis, one return. So will the payment of tax also will be annual, or will have some advanced tax rules like in India where we have to submit the advanced tax every quarter or so?
Yeah.
Kinjal, would you like to take?
Yeah. So currently they have clearly specified that there is no requirement to pay advance tax.
Okay.
So like in India, we have installments and we have to pay on a quarterly basis. We have to assess the income and pay quarterly basis our advance tax. Such rules are not here in this regime, at least.
Correct. Okay.
I would just like to add here one thing. See, again, I believe that UAE would keep it very simple from the implementation and compliance perspective. And I guess there will not be too many filings. Like in VAT, you just do a quarterly filing and then pay once. So similar fashion, I think this is going to be an annual affair where you file once and pay once.
Correct. Thank you. So we'll take up some questions from the attendees. One of the questions is from Sir Sudeep. If withholding tax is deducted for a free zone company in a country which UAE doesn't have a double tax agreement, will the free zone company still get the credit for such withholding tax deduction?
Yeah, in this case, see, again, we'll have to look at the regulations. The broad outline which has come out is not clear, but yes, they have said that if you've paid a tax on your foreign source income in another country, it would be allowed as a deduction from the UAE corporate tax liability. So assuming that, I guess there should be a way to claim it, but still cannot be very certain that the withholding tax would be fully deductible. And specifically, see, again, free zone company probably may not be chargeable to tax, because if free zone company is doing business internationally and it is based in a free zone which qualifies for this corporate tax exemption, in that case, they would not be paying. So effectively, then there would be no case of claiming a deduction again. So both these aspects, I think, will have to be evaluated, and I think we'll have clarity only when the regulations are out.
Okay, thank you. One more question. We have a free zone company who is exporting the goods but procuring material locally. So would that fall under exemption?
So currently
Sorry, go ahead.
So currently what they have specified is the exemption is available only to free zone companies who are conducting businesses with the mainland company. So what is conducting business with mainland company, they have still not specified. So we'll have to wait and watch what the regulations come out to be.
Correct.
So in this case, I think, see, again, what could probably happen is, let's say if they are buying from mainland company, technically a mainland company has to export it to the free zone. Now, if it is deemed as export, of course, which in VAT it is not being deemed, but if it is going outside the custom territory of the UAE, it could be deemed as an export. So in that case, primarily the buyer is just buying the goods and then they are selling it overseas, this free zone company. So in that case, they may not be chargeable. There might be, I think, a possible way to minimize the tax implication in such case legally.
Correct. So we have one question from Mr. Hirchandan Bafna. He would like to ask the question. Can you unmute him, please?
Yeah, sure.
Can speak.
Yes, Mr. Bafna.
Mr. Bafna, you'll have to unmute yourself. You are allowed to unmute, so you can unmute and speak. Or let's go to the next one if he is not able to, or maybe he is not on the call.
So there is one question: will income from export activities will be chargeable to CT?
See, currently, it again depends on if company is in free zone and the free zone has the exemption. Yes, then this may not be taxable. But if the company is in mainland, there is no specific mention of that whether the mainland companies, if they are having export business on that, whether they would be having exemption or they would have this
Okay.
benefit.
And is double taxation treaty necessary for claiming the foreign tax credit?
No, it's not necessary to claim foreign tax credit specifically. I mean, what clearly currently FAQ just says that, yes, if you have paid tax in foreign country, it'd be allowed to claim as a rebate against the UAE corporate tax.
I would just like to add over here that, sometimes it happens like in India, we have, even if we don't have a treaty, a double taxation treaty with another country, the law specifies that we can have unilateral exemption also, or we can have a bilateral when there is a double taxation treaty. So we need to wait for the regulations to come out, how the unilateral credit will work for foreign taxes which are paid.
One more thing in terms of double taxation agreements, double tax avoidance agreements are normally applicable on the income like dividend, on interest, royalties, technical fees. Most of double tax treaties cover this. So if that is the case, then those are not generally the business profits which are going to be taxed in UAE. So.
Correct.
That again may not be linked to the double tax avoidance agreements in majority of cases, is what my understanding.
There are a couple of questions regarding the first return, when it will be to be filed, for which financial it will be filed. So for certain companies have Jan to December financial year, certain companies have April to March. So when will be the first financial year? Because what we understand is the income tax CT will be applicable from financial starting after June 23. So technically, those whose financial year is Jan to December, the first tax period will be Jan 24 to December 24, correct?
Correct.
Yeah, and those who are having financial year April to March, their first financial year of CT will be from April 24 to March 25, correct?
Correct.
Right.
Only for those whose year ending is 30th June, for them it will be 1st July 23 to 30th June 24.
Correct, correct.
Okay, I think we have a few more hand raises.
Yeah. So Mr. Mohammed Akram has raised his hand. Can you unmute him, please? Mr. Akram, you'll have to unmute yourself.
Yes, sir. This is Muhammad Ikram. I'm a cost and management accountant from Pakistan.
Yes.
I want to know that the free zones are fully exempted, or is there any specific criteria or any entity which is registered with any of the free zone, Jabal Ali, Sharjah, Hamriya? So these will be exempted from CT, or is there any criteria?
See, what is the understanding till now is that each free zone in their regulations or in their decree had given an assurance that this free zone companies that you set up in a particular free zone will not be taxed for 50 years, for example, or 15 years or whatever, from the date when, let's say, the free zone started probably. So you'll have to see now what is the balance. Is that free zone still entitled, and is that period not over? If that is the case, then that free zone company will be entitled to claim exemption. But again, to claim exemption, they will have to prove that they are meeting all the regulatory requirements and they are not conducting business within the UAE. So if these broad conditions are fulfilled, we assume that yes, they would be entitled to exemption. But again, detailed conditions and guidelines are still awaited. So once we'll have more clarity.
Thank you.
Thank you.
Thank you. So we have one more question regarding that the company is a mainland company. However, their entire business is export sale. So whether they will need to pay corporate tax.
This is a good question, but no clarity on the answer yet, because yes, free zones, they've clearly mentioned that free zones where it was assured that there would not be corporate tax, that will be honored, those commitments will be honored. But as far as mainland is concerned, there is no commitment that it won't be chargeable to corporate tax. So now if specifically in the corporate tax law, if they come out with a provision where export business is not going to be taxed, then probably yes, but I'm not sure, we can't really say till the regulations are announced.
Any timeline for release of the regulations? When are we expecting?
So in the press release, they have mentioned that in the mid of this year, they're going to announce and release the regulations and the law. So we'll have to wait.
And one more question regarding free zone companies. So as we understand right now that the free zone companies doing generating profits from local business will be taxed. So
Yes.
in that case, they'll have to maintain separate books of accounts, or is there any clarity on that?
No clarity, of course, but see, how do you prove that this is my profit from local business and this is my profit from the international business? Now, that is possible only if you have proper sets of books of accounts where you can classify and segregate that, yes, this is my international business related income and this is my local business related income.
Correct.
So definitely, see, a lot of changes will have to happen in the accounting system, as I mentioned earlier, and everyone will have to ensure that they have proper documentation. See, many times while we are on the subject, I think I'm digressing a little bit, but it's a very important matter. I wish to highlight many a times expenses get paid out in cash and without proper supporting documents, without proper invoices, without proper agreements in place. Now, these are the kind of expenses which will be difficult to prove that these are genuine business expenses. So if companies do not have proper documentation, paperwork and paper trail, there are possibilities these might be disallowed. And so what will happen? Your effective taxable profit will be more than your accounting profit and you will end up paying more tax.
Also, one issue which might come is, direct cost, okay, you can segregate, but how do you segregate the indirect cost into export sales and, export from free zone and local sales? That also will be a challenge. So that also we'll have to wait for the regulations
to come out. I'm sure, I think, see, like in VAT regulations, you have exempt income and you have, mix of exempt and let's say zero or taxable. And then you have basis of how do you allocate the common costs. So similarly, if this is going to be allowed, I'm sure some formulas will come in the regulations itself on the basis of segregating or allocating the fixed overheads.
There is one question that if a license is professional license, management consultancy still required to pay CT. So obviously all license holders in the UAE are under the purview of CT. So every single license holder who has a license in the UAE, even I think freelance license holders also are under the purview of the corporate tax.
Yes, even freelancers. So sole proprietorships, which are, let's say, not an incorporated entity, but it's a sole proprietorship. They have a license, they are liable and they're carrying out business.
I think his point is they have mentioned about the commercial license. They have not mentioned professional license. So I think that's the point trying to make.
Yes. But it would be applicable, whether it's commercial or professional or any category of license. Of course, we'll have to see now the offshore companies, though they do not have a license as such, but they are incorporated active entities. And if they are conducting business within UAE, then it's like a foreign company carrying out business on a regular and ongoing basis.
Correct. So we have one question for transfer pricing. If free zone company is owned by a corporate foreign shareholder, how will the associate company be sought or assessed?
Sorry, can you repeat that?
If a free zone company, it's on transfer pricing. So if a free zone company is owned by a corporate foreign shareholder, how will the associate company be sought or assessed? I think,
associate company, see,
Yeah.
again, transfer pricing, there are very clear guidelines as per OECD, and in accordance with that, one will have to see that are these falling one within the transfer pricing regulations. So, they have defined what group companies or what are the associate or related parties which will actually fall under the transfer pricing guidelines, and then they'll have to ensure that they comply with those.
correct. Like we said, that expenses will have to adjust the profit. So right now, is there any clarity on whether we can give directors remuneration or management remuneration or remuneration to maybe spouse of the directors or managers? Or what if the company withdraws majority of the profit or reduces the profit by charging such remuneration? Would that be restricted?
This is, see, I'm sure if it is a genuine business expense, so if one can prove that the director is actually involved in the business, he is spending his time and effort, whether in executive or non-executive capacity, then I believe that a reasonable level of remuneration would be allowed. And that's where I think the guidelines would come in place, because we have seen in many cases where the accounting profit is then generally transferred to the managing directors or the expatriate partners by way of management fees. And the final net profit distributable is on a lower side because of the 5149 arrangements in many cases. So these may not be allowed fully. I'm sure there will be certain guidelines or limits that, okay, up to this percentage of profit or up to this amount might come. I mean, these are my assumptions. We'll have to wait and watch till the regulation comes out. But I'm sure something will come up in this direction, even interest being paid to the shareholders. There are always loans from the shareholder. So what is a reasonable level of interest that could be paid on those? That might also come in. Sometimes, royalties are paid, or the owners or the directors hold the brand name in their own name, and then technical fees might be charged, or the brand royalty might be charged. So I'm sure there will be guidelines with respect to this.
Yes, along with the corporate tax, there will be the GAR rules also, the general anti-avoidance rules, so which would curb all these practices. So that will always be there in place.
Okay, we have one more question from Mr. Sham. Can we unmute him, please?
Hi, sir. My question is, I heard in this conversation, this loss of one intercompany can be set off from one profitable another intercompany. So we have a real estate, school, hotels. So my question is suppose a hotel is in loss, that loss we can set off from school profit or real estate profit, like that?
Okay, so this one, see, one thing, the law clearly says that there will be registration, like, you have TRN, tax registration number, as a group entity. So you can group your multiple companies into one tax group for VAT purpose. Similarly, for corporate tax also, you'll have an option that you can create tax group. So if you have all these companies within one tax group, then the loss of one you could set off against the profits of the other, but effective from the date of implementation. So if you have past accumulated losses, then you will not be able to carry forward and set off going forward, only from the date of implementation.
Okay. And I have one small question. We have a real estate in company and personal. So personal real estate will not come in this CT guidelines, right, sir?
Yeah, personal taxation is not being proposed or brought in. It is only corporate tax where it is being conducted under an entity's name. So where you have a license. So if you are having real estate business in terms of your holding property and earning rental income, for example, in personal name, that will not be chargeable to tax.
Okay, clear, sir.
Thank you.
I would just
One
like to
question.
add, in such cases, you could be a VAT registered person, but you need not mandatorily be registered for corporate income tax.
Yes, very important. Because there would be again two different, your VAT is based on the value addition or the supplies that you are doing, not on the profit, whereas here it is on the profit. And that also if you are doing business in an entity name, whereas in VAT, individually also you are liable to register for VAT.
One question we have is, are foreign branches profits will be taxable for corporate tax? I mean, will be.
Yeah, this is not very clear right now. Obviously, see, if it is a corporate tax, generally corporate tax will be on the profit as per the accounting standards, accounting report prepared in accordance with IAS. IAS clearly says that it is to be consolidated financial statements, which includes, of course, for the entity, let's say you leave the subsidiaries out, but when you prepare for an entity, it includes your UAE as well as all the branches, whether it is UAE or overseas. So technically, yes, it gets covered in your accounting profit. Now, whether on the foreign branch income, will you get an exemption or a deduction, so-called, which is a possibility, of course, because technically, I think, see, what happens is in this case, the broad understanding that I have is UAE is going in more for similar to, territorial system, which Hong Kong or Singapore follows, where only the locally sourced income is taxed and international one is not. And this is my understanding. Of course, as the regulation comes out, we'll have more clarity. So if that is the thing which is being followed, then there is a possibility that foreign sourced income, there is a possibility you might get the exemption or some sort of deduction and you do not pay. We'll have to wait and watch again. I think many questions may not be fully answered. I'm sorry, but this is because the regulations are not out yet.
Correct. One more question, that if new company, new free zone company incorporated, so their tax exemption, which the respective free zone company gives for say 50 years, that will obviously the 50 years will start from that day. However, provided they fulfill the conditions of claiming the exemption, like not dealing with the local parties or not selling locally. So that will always remain, correct?
Yeah. Yes. See, generally what the understanding is, all the free zones by decree, they offer this corporate tax exemption. Now, decree generally, mentions that from the date the free zone is set up or incorporated. It's not generally from the date the company is set up. So effectively, if the free zone is set up, maybe 15 years might have passed. So then remaining might be 35 years or 20 years or whatever.
Correct.
This is the broad understanding. So that will have to be checked with each and every free zone, or wherever the free zone entity is set up. You'll have to check with those free zone authorities that the corporate tax exemption that they are assuring is up to what period.
Correct.
Because 50 years talking is probably going to make more confusion. They could say that no, 50 years from decree date, and I could assume that no, it is 50 years from the date I set up my company. So better to, I think, have clarity from the free zone authority itself that up to what period are you assuring the exemption.
One question I also had, sir. Will there be a concept of designated zone and free zone also, like it is there in VAT, that fenced will be only considered as a designated zone?
I'm sure. I think because see, certain free zones, though they are free zones, they are still, providing services within the UAE because they're not fenced. Generally, goods are being sold within the UAE. So
Correct.
Something of that can come up.
I think there is one question for transfer pricing, but I think the transfer pricing regulations are not yet very clear. So answering how that will work is a bit difficult at this stage. So I guess these are the questions which we have. We don't have any more questions. Also, time is almost over. So I think we'll stop at this stage. And I thank.
I think if any, just any last questions, if someone wants to ask, and maybe we have missed out in the Q&A, please, I think, raise your hand. So we'll wait for 2 minutes. If there are no questions, then I think we can.
There's one question that will corporate tax be payable on dividends? I mean, it will be paid on dividend after declaring, I mean, profit after declaring dividend or before the dividend. So obviously it will be before the profit, which is before the dividend, not after.
Yeah, so see what will happen is, I think in the example also it was shown that there will be, from the accounting profit, you will add certain disallowable expenses and you will deduct the income which is not chargeable to tax, like dividend or some qualifying income as we call it. So after that you arrive at the net taxable profit.
Correct. Anyone has any other questions? We would love to answer a few more questions if anybody has.
I think one question that I can just see is offshore companies earn income in terms of interest on FD investments within UAE is taxable. I think interest and all that, there is a clarity that it will not be chargeable to tax. So there may not be any question of tax payable on the interest income from banks. Of course, if someone is carrying out business of lending, then it is not going to be exempted, then it will be chargeable to tax because it is a business income then.
Correct. So in the same way, if intercompany advances are given with interest, then that interest earned will be a part of the adjusted net profit.
Yes, in all probability, yes, because it is not an investment income per se, as I said.
Correct. Fine. So I guess we don't have any more questions. So I would request Jyotika to please propose a vote of thanks.
Thank you, sir. Thank you very much. So that brings us to the end of the session. We hope all your queries regarding the new tax regime that's going to be implemented in the UAE has been sorted now. Having said that, if you have any further queries, you can always reach out to us. We shall be more than happy to help. I'd like to thank my speakers and the IT team for the constant support and the effort that's been put in organizing the session. Thank you everyone for your time and participation. Thank you.
Thank you everyone for joining in today. Thank you.
Thank you, everyone.
Thank you. And then we'll circulate the presentation very soon. Thank you.
Thank you.